Uganda is heading to the general election in the next year, and someone asked me to do a retrospective review of the impact of general elections to the investments in the Treasury bond. Now, there is one thing people need to appreciate. Most countries, Treasury bonds interest rates or interest rates across the different markets, even if it's for both borrowing from the commercial banks, they reflect the risk that is inherent in the country at the point in time. And the data I have for treasury bonds can go back up to like 2015, 2014, 2015. And there is one thing you should always appreciate: the political risk. Every time there is a political risk, a heightened political risk, investors always request for a higher interest rate, a higher return for their investment. We have seen it in Kenya, we have seen it in Tanzania, we see it in different countries, even in countries like the US. Now, for the Uganda, every time there is next to an election period, three things happen. There is a lot of corruption, there is a lot of unexplained budget expenditures, there is a lot of money flowing around because of the election period. And to investors, those things are what they would look at, and they, especially institutional investors, and always demand for a higher interest rate or a higher yield. Now, I'm showing you a graph that goes up to 2015 for us to predict what might happen in the future. In 2015, we had an election in 2016. You can see in 2014, interest rates were at around 14.125, 14.2. Then when it comes to 2015, you remember between 2015 to 2016, we had our election in 2016. But 2015 to 2016, there was a lot of political activity. That was the time of the go forward of Amama Mbabazi. That was the time when the BSG were trying to create a united front. That was the time when the government was trying to make sure they, like, there was a little bit of a transition from the old guard of NRM to the new ruthless guard of NRM, the Todwongos and everyone. And there was a lot of money in that election. There was an understanding that Amama Mbabas had a big stash of cash and he was about to challenge something big. We had to Mukunde. And you remember that was the time interest rates had to rise up to reach almost, by the end of 2016, we had reached close to 18%. Yes. But the people who invested in treasury bonds in 2016 in Jan, the interest rates had reached almost 18%. But one thing you have to also remember at that point is this: in such times when we have election, there is a little bit of pause in funding by global entities, especially in the civil society. In 2016, actually, there was a lot of pausing of funding for almost 3, 4 months, because it's when it comes to Uganda, it's only Ugandans who can always predict what might end up happening. So in 2016, there was a little bit of a pause. Not a little bit of a pause, and always that when the government can no longer easily access that foreign direct investments, when the donor money stops to flow, when we can't export so much of the things because of those so many factors, that's part of the reasons we end up seeing the interest rates rising. And you can see this is around January 2016. The highest was January 2016. After January 2016, if I'm to make this graph a little bit bigger for the people, after Jan 2016, then you ended up having interest rates going down. Now, after the election, now they have stabilized. We know Museveni is coming back. As usual, he announces his cabinet. We know who is the parliament, who knows the vice president. Now there is a little bit of settled pressure. The political risk is coming down. Now investors are starting to come in. That's when they started launching the Namave industrial park to bring in, attracting more investors. A little bit of good news, and interest rates had to drop down. But because it's Uganda, there will always be some heightened risk. So by 2018, interest rates are around, they are back to 14%. We are about to enter into 2019. We are starting to have a little bit of pressure for election in 2019. You know, in 2 years before the election, that's when the pressures of election starts to happen. Boom, interest rates rise up again and they reach around 17%. Then 2019 they go down. There is a little bit of management up. Then we come to 2020, 2021. Remember, at that point in 2020, 2021, it is a COVID year, 2020. Few things happened in Uganda. Uh, Whereas in other countries, the government almost subsidized everything. They borrowed money to pay off people paycheck. In Kenya, Uhuru Kenyatta paid the citizens some more M-Pesa. In the US, they were what we called the COVID slips, where they were paying citizens some real money, which they had to borrow significantly. In Uganda, Museveni chose to just sit on his hands. Actually, I remember, is he called Emmanuel Katongole, where they were collecting money to afford to buy Posho from Aponye, rest in peace, to enable to pay people. The government retail didn't do. Actually, the spending of the government went down, almost down. And what that ended up happening is the cost to the government funding was so little in the COVID period. That's why interest rates didn't rise at that point. And interest rates were down, foreign exchange was down, but the government spending was down. So between 2020 to 2021, the interest rates remained between 15 to 16%. Then by the end of 2021, we are entering 2022. At that time, the government needed to rejuvenate the economy. The economy was now on its knees, and the government needed to rejuvenate to recharge the economy. In 2022, that's the first time then they issued treasury bonds that literally reached close to 18.5%. Yes, we have a 20-year treasury bond of 18.5%. We have another one of 17.5%. Interest rates in 2022 rose to the highest. At that time, inflation was almost 7-8%. So it was extremely expensive to borrow. It was extremely lucrative to invest in treasury bonds. So, but after 2023, there is a little bit of stability. Now the economy is back to normal. There is flying, everything, justified expenditures, everything was stabilizing. Now we come to 2024. Now we are in 2025. We are going into the election. Because we are going into the election, one of the things you have to end up realizing is this. Uh, that what ends up is going to happen is this curve that I want us to look at. You know, let me put it there. That in the end of the day, there is something that we have to pay attention to. Where is it? Come on, I want you to show up. Yeah, that white graph that is going through the curve, right? You can see it's starting to point upwards. What it's indicating is that the market is starting to price in an increased risk in the treasury bond market. And what that ends up creating is that in the future, as we enter into the election period, you expect the pressure on the on the treasury bonds to increase. The investors would demand a higher interest rate, which means interest rates are going to increase, but that has a double effect on the borrowers. It means banks sometimes they end up reducing the borrowing to the private cap sector, and there is a little bit of a squeeze in the economy, because it means everyone is now moving into the havens of treasury bonds, and the critical sectors that will boost the economy are literally going down. But also we know when it comes to countries like Uganda during election period, where the government can spend as much as it wants, which they have access to classified expenditures in different budget line items, then all of a sudden their desire to have more money is high, and that automatically creates that upward trajectory of interest rates. So for anyone who is trying to think through what's going to happen in 2016, I cannot easily predict how much it's going to rise, but we expect interest rates to start rising, maybe beyond what they are. They are already high, and now we have seen last week where they passed the private a supplementary budget, no, public supplementary budget of 4.2 trillion, which is almost 7% above what the budget they passed, the highest budget they passed last year. That budget is going to be funded by borrowing from treasury bonds and treasury bills and external borrowing. That automatically creates a higher pressure. As we start to see the government debt reaching the new heights of 100 trillion in a year, 110, 120, that pressure, that means we start assessing the country. capacity to pay it back, especially at a time when we know the tax base is shrinking because of so many different other factors. The economy is literally struggling. So people are starting to invest in treasury bonds from a perspective of betting that the rates are going to continue increasing. But when by the time the election period is done, the economists know as soon as the election period is done, the electioneering is done, it's time to tighten the belt. And when you tighten the belt, the rates start falling. That's the challenge is that the rates will start falling in 2016, 2026, 2027, where we start expecting oil money to start coming in 2027. Now, two things are important. The government borrows money because it has no access to other funding or revenue. That means the taxes are not enough to fund its operations, and they don't have access to other funding like the grants and aid and everything. If the oil money comes in early, or we start seeing it and they project that it will start in 2027, then in 2026, as soon as the election will be done, rates will start falling because now the government will not need to borrow long-term borrowings because it knows it's about to access some cheap, free oil revenue. It's not free, but it will be government revenue. That is the dynamics that might end up playing, which people would have to think through and be like, how do we manage that? I would say we are entering into a zone of to invest, a zone of investment component. Invest, invest, invest. If you do not have that, that would be the position you want to take in. Interest rates are going to rise. We have seen it happening. Inflation always rises. It's a demand push inflation. It's a demand push inflation. There is always so much money in the market. There is always so much money in the market. The FX sometimes gets a hit for the first 2 3 months because the diaspora remittances sometimes they pose money they are sending back home as they're trying to see how the economy is going to perform, and all that plays be, back and forth, back and forth. But for you who is trying to invest, this is the time when you start collecting your funding here and there to make sure you take advantage of the period that are coming. Thank you, Alex Kakande.